S&P stops at a critical level. Nasdaq reverses off a control bar, forming a shooting star. What the value versus growth chart is showing us, wants versus needs, is rolling over. Why? Which sectors look ready to break out? Which look exhausted? Netflix and what to expect next week. Apple, we've seen this pattern before. Why are the credit card companies breaking down? Why the inflows are going into real estate investment trusts. What New York Stock Exchange margin debt versus growth is telling us. Small speculators closed their net short position and what this means going forward. We have a ton to go over. Let's get to it. Hey guys, welcome back. To start, we're just going to look at the weekly. We can see the RSI is over, but we should probably just talk about this level. And we got to it and we just rejected. We got to that 46.10 level, and that's okay. It's not great, but this bar right here, I'm not really crazy about that bar. It doesn't really have follow through. That's where we're shooting for. You want to start seeing this kind of trajectory, or want to get into that. Then the question becomes, what are we getting? Now, I personally think we're getting more of a cup formation. Now you can see that cup right here, and if we're getting more of that cup formation, then maybe what we're going to get is some kind of handle. Now, if we're going to get a handle, then we're going to get some kind of pullback. We've been talking about this pullback for some time. There is a lot going on here when we look at this chart. For me, there is anyway. For example, I use that as a left shoulder, head, shoulder, and then you see the neckline going straight across here. I think there's something to that, but at the same time, I think that getting up to this level, you're starting to run into some resistance. And I think that that is going to be something that we're going to have to watch very closely. Now, if we just drill into this and look at that bar, we should all be familiar with what kind of bar this is. That is a gravestone doji. That is not really what you want to see at the top of a chart. Usually means you're rolling. It should not be surprising if you go through and look at these bars over and over again. You had a ton of green bars. We had one here and then we just ran it over. You're starting to see this develop into something else though. We just want to watch it. We want to be real cognizant of that and put in our moving averages. We're not even down to the 12 yet, let alone the 22 or testing any of these. We're not really testing any area. And it's very realistic to think that you're going to at least test your 12-day moving average, which puts you at 4,500. That you're not that far off, but that's a drop. And then a 44 3/4 is not unrealistic. And then you kind of walk your way down, but I don't see this as the worst thing in the world. Now, we are seeing some rotation, and we'll get into that in a moment. But I think if we look at this, we just have to understand that pullbacks are not bad, and we were due. Now, let's start with the Nasdaq on the weekly. This is your control bar. It's not really even up for debate at this point. This is when we broke down, and this is how we're acting. We can see the same curvature here. We are seeing some differentiating things here, different from the S&P, and they are a little concerning. First and foremost, this breakdown was substantive, and you can all see that right there. Tries to rally here and fails. And then you just start having these lower lows the whole way down, until we finally have that lower low, which happened around CPI, and then we start curving, and you can see all this. Now you have that same curvature, but now you've gotten to this key level. Now, if you start looking at these key levels, this is where it gets really interesting. If you draw a line coming straight across, and we just use the body, you can see how that became a support level. What we're going to want to watch is we're going to want to watch that 14.9. So you were looking for a level and saying, okay, well, what's going to tell us whether or not we're going to break down more? I wouldn't really be looking at that 15. I'd be looking at where we held here. Wicks are price rejection. We are fully aware of that, so you're not going to have a ton of support there. But that line right there, I'd watch this like a hawk and see if they're going to come in there and if they're going to hold that area or not. The other thing that is troubling to me is this. That is a shooting star, and that is the top of the chart. Now, we could all say, well, it's because we had trillions of dollars in options expiring the same day. You know, all those people that trade options, the day options, zero option dated trades. I could do a whole video on that, guys. I mean, 80% of those expire worthless. The idea that there's some kind of just system that's going to work all the time on those is it's just not accurate. But there is ways to make money with them, but it's the majority of people are going to wind up being on the wrong side of those. Anyway, see where this is and see how you're holding. But now you're at the low of the day. A lower low gets you an outside week. I personally don't see how this holds. But 40% of all S&P earnings are next week, including big tech. anything can happen. This chart can change very, very fast based upon that. I can sit here and go through all the earnings. There's many that it's not really worth our time. Just understand 40% of all S&P is going to have earnings. You have the Fed next week. We all know that they're going to raise rates. Shouldn't be a shock. If they don't raise rates, the market's going up, period. That's as much time as I'm going to dedicate to it, because there's over a 90% chance they're going to raise. If they don't raise, the Nasdaq will move higher significantly on that, period. It's irrefutable that is what will happen, unless he starts talking about the economy coming in very hard, and there's no way he's going to do that. Now, I want to flip these to a line, just keep it red. 5-day moving average on the S&P, percent of stocks above. When you get to this level up here, it is usually a short-term top, and we just got to that level a little bit ago here, and then we had that sell-off, and you're kind of in no man's land on the short term. Longer term, what is getting a little concerning, and I'm going to leave these red because I think it's obvious to see them, is when you get up to this level around here, you do start seeing some kind of pullback. Now, if you go back and take a look at November 28th, and you go take a look at August 8th, November 28th and August 8th, and you take a look at the S&P during those periods of time, let me just find it for you, you'll see that. So here's August 8th here, and then here is November 28th. When we start getting to that level, that is a level that I do pay attention to, and I think that people would benefit from paying attention to that level. Now, if I take a look at the S&P during the same period of time, and I look at the 200-day moving average, well, this is a real long-term movement. And so if I just come here and I say, well, we could say, okay, well, January we were over, okay, and then here we were over, okay. I'm not really getting anything from that. If I look at the S&P, it's not really giving me the same kind of signal that this 50-day is giving me, which is more of an intermediate term. Hey, you might be near a high. And of course, what you want to see is not the increasing of the 50, but like everything else that we're about to go over, and I'm going to touch base on today, the trajectory of the move when it starts to roll down, and the velocity in which that happens determines the magnitude of the move. You might want to listen to that again. So you look at something like this, and you're just watching it, it's not really telling me anything. So what would tell me something about this? Well, there's a couple things. One, we already know, and we've gone over this for those that are new, and I really do appreciate everybody sharing these videos. I purposely don't put ads in the middle of them to not waste your time. Please share it if you find value in it, and I do believe that there is value in these. I do get emails from people when you share them that actually are thanking me for the work that we're putting in. So it does help get the message out there on what it takes to be successful at trading. Here's our level right here, that 50, and we're not breaking it, and you can see we have some issues at the 40. What would I want? What would concern me here, and what would be the issue? The issue would be what? If we start to roll from that level. If we start to roll from that level, I would want to know, what am I going to look for? I'm going to look for the trajectory of that roll, and then the magnitude or velocity of that move, and that's going to give me the magnitude of the move. I don't see anything here on the above the 200-day that I would look at. If I had to find something and say, hey, this is an issue, it's that 50-day, but right percentage of stocks above the 50-day, and anyone can look this up. The symbol on TradingView here is S5VI. But if you watch this, you want to see if we're going to turn. Now, if we don't turn, we don't have an issue. We could just stay up here. That's why the trajectory and velocity of the move are important. I hope that makes sense. We take a moment, look at the Russell, and 15.6% of the Russell is financial services, and we all know how they've been doing. You're starting to see a divergence, and I'm not really putting in a lot here yet, but I just want to walk through what I'm saying. They're walking you up a little bit. They're trying. Now you have this bottom line here, but take a look at this, and I thought this was really kind of interesting how they're doing this. There, and draw this one. They're kind of walking you up a little bit. So this is getting tighter and tighter, and that does fit, and it's going back a little bit close to 2 years. Let's go back 18 months and really look at this and say, well, we really haven't gone anywhere. Well, you also haven't broken down. When you start going through like KRE and looking at that on the weekly, which is your regional banks, you'll notice a couple things here. Shoulder, head, shoulder. You are not breaking down here. You're doing the exact opposite. Everybody thought you were going to have bad, and we're going to get into some of the names that in a bit here. But I think we have to talk about market structure. and what's going on first. If you take a look at KRE, just as, again, this is on a weekly chart, I don't see anything here at all that is negative, and that really is the Russell. Keep that in mind, that they benefit the most from that, and that's something that I would pay attention to. A couple of the sectors I think we should go over and start looking here at what's going on. Basic materials is starting to pick up. That is a little bit of a defensive sector, and it's starting to kind of build. We have this huge base for the past 2 years, and you should be able to see this, but you can just see right here how you came out of that base for a little bit, and then you just got back in it. You have that area where you kind of came out and everybody said, we're not going to need any basic materials ever again. And then you can kind of see how we're starting to lift. And you were out of that for a little bit up here as well. But you can see where the basic area is. So you want to see if you're going to break out and actually get above all that nonsense. And I don't know the answer to that yet, but this is a defensive sector, so I would pay attention to it. If you go through communications stop dead with their control bar, very similar to what we just saw when we were looking at NQ in that control bar. That's something we want to watch, because maybe watching the communication service sector and how that acts could be used as a possible precursor to what the Nasdaq's going to do, something to think about. Now you have this little area. Oops, I'll go back to my other arrows. Now you have that little area right there, and I'd want to watch that. If you make a lower low, you have the potential to roll here, and that's what we want to pay attention to. You're at a critical level here. I really don't need a lot of indicators here to give me any more color, because those indicators are all going to level off if we go flat. What I can do is just look at this and say, hey, I have a tweezer top and I should probably be aware of what's going on here. And you should all be able to see that you have one where you have that wick and then you have the other wick right here. And that kind of gives us that tweezer top appearance. If you think about a pair of tweezers, you don't want that. That's not good. What we don't want to see is that breakdown, and this would be your Metas of the world, your Googles of the world, your Netflix of the world, and we'll go through a couple of these names in a bit here and tell you what names I'm looking at. But 40% of the S&P comes out with earnings this week. Something to think about. If you take a look at energy is going higher. Well, I thought we were going into a recession. Well, if you're going into a recession, energy does not go higher. It's just, again, you're starting to see some huge disconnects here, and you had what I referred to as a kill zone. We had to make a decision. In other words, you were getting super tight in here and you had to make a decision. Well, you made it, and they're buying energy names, something to think about. You look at the XLF here, financials. Now, where are we getting? The top of a control bar. I personally think you're going to get through that, but I have no idea if you really are or not. Now, if you come here and you look at this DTL's downward trend line, where does that take us? The top of it, and that's where we stopped. This is pretty telling, and this is an area of great interest and great concern. At the same time, if I am to look at the subsectors of this and I start drilling into like KRE, I like the way that's acting. Now, what I don't like is acting that's also in the financial services field is AXP, and I'll get more into these names later. When Amex is out increasing their issues, and their issue is loan loss preservation and protection of capital. You can see these earnings, but revenues are down. But now they're starting to put more loan loss reserves out there. That's why this broke down. That's usually not a one-day event, guys. I'll get into this later, but I have a short position in this. That's a concern when DFS is out there saying, oh, we're going to have to rewrite our books are way off, and we drop 10%. That's kind of a concern. So we have a problem with the consumer. You see how MasterCard's got the shooting star right here, and you can just start seeing how they're selling Visa the whole way down. Are they thinking that the consumer's getting worse? Is that why we started to see some of the high flyers start to break? Is that why they started to break? I don't know yet. I don't have an answer. But from the financial field, to get back on point, this is an area of great interest and great concern. I think that if you had to break out the subsectors after what I just showed you, that it's not even the large cap names that look the best. It's really the other names, in my opinion, that look the best. It is the smaller names that look the best. US big banks, if you break them out as a subsector here, which I just did, and you look at your trend line, well, that trend line fits perfectly with this XLF. If you start drilling into the regionals, well, the regionals are basically saying we have an inverted head and shoulders, and all regional banks are not going to zero. Start doing your homework. And you can see this gap in here, and it's massive. One investment vehicle that people play with and might want to look at is DPST, which is a 3X regional bank, but we'll get into ideas in a bit here. If you take a look at tech and the weekly, you broke out, and now I've got this gravestone at the top. I do not want a gravestone at the top of my charts. I had a gravestone here. I do not want a gravestone at the top of my charts. It's really that simple. There's not much more for me to say about it than that. If you drill into the staples, you can see the staples are holding in here, and everybody was buying the staples, which means they're buying Procter & Gamble. Everybody's buying toothpaste, Colgate. They're trying protection of capital. We know we need Clorox, wants versus needs. That's where they're going with that. So that was something that we had to pay attention to. Utilities, please excuse this wonky line, but utilities, you can kind of see how you're getting wedged in here. Even if we go from the top to here and we drill down into this, which really I don't like too much. It doesn't, I'm coming off of wicks. I'm not really crazy about that as a formation. But what I would suggest is, yes, is it there? I'm more interested in how this is getting tighter and tighter, and that's something that I'm watching. I don't think those lines are the best in the world just because they're all built on wicks. And then you get into consumer discretionary, and the names have been on a tear. I did quite well. What are we running into? Here's our control bar. What happened? We tried to get through our control bar, and then we got Matumboed up here, and you can see the shooting star here as well. These are things that you're starting to see the leading sectors and cyclical sectors rolling. It's why I spent time on this. And you're seeing the defensive names go up. This is a weekly chart. Very important to understand that distinction. Just to go through mining, mining can't get out of its own way. If we drill into these and we look at VTV versus VU, value versus growth, and we look at what's happening here, value has been getting crushed. We've been getting crushed since 23. What do you have here? You have a reversal pattern. You completely undercut this bar, and now you lift it. That's the definition of a bullish engulfing. If you want the true technical definition, the complete encompassing of another bar. They're starting to buy the value names back. And does that mean that this has played its course? Maybe. Maybe it has played its course for a bit, and that's something that we're going to have to look at, something that we're going to have to watch. Did we play out here? Has this played out? That's something that we have to pay attention to. I don't have the answer yet. All I can tell you is that I'm watching this, and I think it's very important. Now, the other one that I take a look at a lot, and as everyone's aware, we've been following along, is wants versus needs. You take XLY divided by XLP. XLY is what we want. XLP is your Clorox and your Procter & Gamble's we just went over. What's happening here? This is my control bar. You can see the break there of that. You can see that bottom in that area, and you can see how these wicks, rejection. So let's just draw a line straight across. Tries to get near it, can't. Forms a little shooting star, breaks down, and that's kind of wonky, but here you are trying again, and complete utter rejection, Matumboed. Now what is this telling you? It's telling you that they're saying, okay, that is enough of the consumer discretionary names. Retail might have a problem, and we just went through DFS, AXP, how they're increasing their loan loss provisions, and DFS has a real issue here. But what is this telling us? It's telling us that we might be setting up for more of a rotation than just a very simple pullback. So we need to watch this. At the same time, I have to preface all this with you're going into earnings this week where 40% of the S&P is going to release. Anything can happen if we had good earnings. So far, we have not had the best earnings start. But I think we need to take a look at the market internals and the structure and what it's telling us. One of the long-term graphs I like to look at is New York Stock Exchange margin debt as a percentage of growth. And why this is important is it basically shows how much is margin growing versus the New York Stock Exchange. And this is really a longer term indicator, but we can see this green line right here. And the important part of that green line is that that is when you are overly pessimistic. And we can see how that is something that took place in 09, or rather 19, and we can see how that took place all the way through the pandemic. And then all of a sudden we had slower growth, and then we obviously pick up, and then the margin debit versus growth increases well over this line, which is your very optimistic and is pretty much something that is supposed to give you a kind of a warning signal. I would use this more as a very long-term indicator, and I'll show you why in a moment here. But when you're peaking here, you don't know where this is going to end. You don't really want to get out when you see this kind of stuff. What you want to do with it is you just want to be aware of it. This can, once that breaks, this can go on for some time. We just don't know. Now, where this gets interesting is when it starts dropping after you're over a key level, and then you can start looking and seeing how that acts. There's something else that we're going to talk about in a moment here that we used to go through a lot. But when we're starting to just come over, we're just really starting the move. We're still on that upward trajectory. Now, this is a long-term indicator, meaning this is something that's telling you what's going to play out over months. And I'll give you some examples here. If we're going to take a look at this and go out, let's go out 10 years and then look at the probability of being under this level, which is considered pessimistic as a percentage of growth. And you're really not there very often. I mean, you were there in 16, you were there from 19 during and then the pandemic period of time as well. And then when we broke, we were there, and now we're trying to flip back over it. That's 10 years. Now, if we go back even further, let's just jump to 20 and say, when were we there before? Well, this is the great financial crisis. And you can see that we were down below this on a percentage basis for well over a year. And why is that important? Because if you were buying stocks during that period of time, you didn't do well. In other words, you don't really want to be buying when you are breaking that level. You want to be buying when you're turning up if you're looking long term. Right? It's that turn up from that bottom that's going to get us. In other words, we want to see it approach that line, just like when we're up here, we don't want to see it what? We don't want to see it approach that line. It's the turn that gives us some kind of signal. It's not so much where we're at. That's important, but it's secondary to the turn once you're over the line. And you should be able to see that here as well. And then, of course, here, I mean, it doesn't really get more glaring. And then you can kind of see us right here, the most recent time where we're under, and then from that turn on, where New York Stock Exchange margin debt in regards to percentage of growth, you can see how we're turning, and now we're crossing that zero line. So should we be looking at this and saying, well, we need to be getting out because we're not as overly pessimistic? And then all you could really do is just look at what happened here 20 years ago and just look at these levels and compare these levels to what happened to these charts during that same period of time and say, were these times that you would want to get out if you were a long-term investor, or are these times you'd want to get in? It's really that simple. And you just do it the other way as well and say, well, did this make sense to get out or not? If we were long-term investors, is this something we should have paid attention to? And nothing's going to correlate perfectly, nothing. But I would say that the higher you are and then crossing that line, the more at risk you are. But if we go back even further, and this takes us to 52, we're going back pretty far now. And again, the reason for looking at this far is just to see how many times have you actually been at this level. You start realizing that, in 40, 50 years, I mean, how long have you been here? You haven't been here that many times. 1, 2, 20 years we've had this indicator go off 3 times. If you really think about it from that perspective, and actually it's 70 years, but if you think about it from that perspective, and then it's even more glaring, doesn't it? When you put things in perspective and then just keep going through and go, well, in 70 years, maybe we could argue that this happened in 73, 74. Maybe we could argue that. But we haven't been here that often. And that is something that I think is worth paying attention to. Now, all these graphs that we're going through, they're all Sediment Trader. I actually pay for this service, and I've talked to them that I'm going to use these for the video. But if you want that service, it's there. I have no affiliation with them whatsoever. We've gone through this graph a couple times this last hour. What this is it's what happens during the last hour of the market. Are there net buyers? Are there net sellers on the advanced decline line? What's great about this is it's a cumulative AD line for the end of the day, for that last hour. And we all love the last hour because that's when institutions make the majority of their moves. We've been talking about this from January. We talked about this move, we talked about how it changed, we talked about how we approached this line here and started getting back over it. What are we doing now? We're dropping. They're selling the last hour and been selling the last hour since about April, May. We're not seeing, and I want to be real clear about this, and you can see it in the trading at the end of the day. You could see it on Friday, and we're going to talk about Friday. But you're starting to see a change here, and we need to be aware of this. Now, if we're going to just very simple level off to something, I don't think we have to concern ourselves. What we have to watch is, are we going to get something like this where we're going to have this prolonged downtrend on the hourly. I mean, it starts with the top. We just don't know how deep that top's going to be. Is this going to stay here, or are we going to come and try and test one of these levels? And what would that mean for the market? Well, eventually the market will give. Now, I'm not saying it's going to give to this magnitude, but if we don't have that institutional sponsorship, it's going to be an issue. And you're starting to see signs of that institutional sponsorship stop. I'll give you an example. This is a graph that we've been looking at for some time. Small speculators index positions. Now, here we are, we're out 10 years, right? If we look at this and go, okay, well, this is 10 years, and what's it telling us? Well, it's telling us, and we use this for funds under 20 billion is how I refer to it. And we could see the line right here, the overly pessimistic line where they are short. We look at these levels here and we see how short we've been. And then we just go back through history and go, well, here's 15 years. Have we ever been this net short, the S&P? How about 20 years? And we go back to the 90s. You've never been this short, ever, period, for this prolonged period of time, ever. And since this has been recorded, this is it. That's a better way of me saying it. Now we know that, and we know that this is extreme. No matter how you want to say it, that's extreme. And we can see it as I click through there. All right, we know we have an extreme reading. See how we're starting to get to that zero line? We've been to the zero line before. What is this telling us? These small speculation positions of the S&P that they were net short have covered. What does that tell us? Well, that tells us that the buying that we had that was helping us is stopping. Well, that buying is stopping. What does that mean? Well, that means the names that were really pushing are going to slow down. Well, what names were pushing? Apple, Microsoft, Netflix, Nvidia. Any of those names, they were the drivers of the S&P. We all know this. Well, if the net shorts are done covering and you hit the zero line, so you're not at an extreme reading anymore, there's a probability that you're going to see a value growth shift now where people are going to, quote, stock pick. And this is actually the part of the market, frankly, that I really like the most when you have to start digging into the fundamentals of companies. You can get an edge, you can get a real edge. And I'll go through that in a moment. But I think this is a really important distinction that we need to pay attention to. Now, one of the things I get in the comments a lot is to follow up. That's exactly what we're doing. We're following up. Last week, I was really trying to make this pitch for people to start looking at the financials on Saturday. I did it at the end of Saturday's video. Everybody has to make their own decisions. I'm just trying to point things out that I'm doing and then how you can benefit from it. And we've all seen the financial names this week and seen how they're going. I just want to take a moment to just review this. This is corporate inside buy sell ratio. This tells you where they're at, if they're overly pessimistic, if they are overly optimistic in their buying versus selling. If you look at this ratio, and you look at where you're at right now on that ratio line, we just take a moment and just draw a line coming straight across till 2011. And you just look at that. How many times have we been here? 4? I think we could say that maybe we've been here 4. All right. We have an understanding of how crazy the amount of buying is in financials right now. You've been here 4 times. Well, let's drill into this and just see how they've been on the XLF when they make these moves. That's 20, 15, 10. Start drilling into this a little bit and starts getting a little bit of data. We could see that bottom there, very clear, and we could see how that bottom's working. Then we could start seeing this bottom, and what did that tell us? Well, that's enough. They couldn't wait to get out of their stock. They could not wait to get out, period. You can see these levels and what happened when they got out. And of course, this is the XLF, and we're seeing it again right here. Couldn't wait to get out, and then you just get underperformance. You're not getting a huge sell. Couldn't buy fast enough. Couldn't buy fast enough. Was that a good time to buy the XLF? Couldn't buy fast enough. Couldn't buy fast enough. They know more about their companies than we do. They know more about their banks than we do. One thing that you can do to differentiate yourself, to get an edge over everybody else, and that's really why I make these videos, to help people get an edge, not to just pontificate. And what I want you to understand is there's an edge in understanding this. If you take what I just went through here, and then you go and see who is buying their own stock in the open market, you're going to get a lot of ideas. And there are 3 to me that have been absolutely glaring from last week, and we'll go through those. Now, I just want to take a moment with this graph because you see it all over social media. AAII bull ratio. What this shows is How many people are bullish versus bearish that are investment advisors? AAII investment advisors. All I keep hearing about is, oh, extreme greed, extreme greed. Here's an extreme greed reading. Look when that took place. Look what happened to the market during that period of time. Here's an extreme greed reading. Look what happened to the market. Now, you didn't know you were walking into a pandemic, but you can see it's not that is the issue. Again, where is this data really valuable? I would not look and say, oh, it's extreme fear, therefore or extreme greed, therefore we have to get out. I mean, here's an extreme greed reading. Was that a good time to get out? That's not how I would utilize this. The way to utilize this graph is to look at the trajectory of the move and the velocity of the move. In other words, how I would use it is this. Let's drill into a 3 years. Now, do I care that I'm over that level? Not really. I might care if I start doing this and I can't seem to get over other areas. The trajectory of this is what? Putting me in a position where I was up here and now what's happening? Now I'm down. Now I start to see that and I start to change that trajectory. Yeah, that's an issue. When I start seeing this kind of move and that velocity up where I am literally, you start looking at that line and then you realize that you are straight up. I want to pay attention to that because that means that they're out of pocket. Meaning they did something, like they're off if you're seeing something like that. If you start seeing moves like you saw here, where you are just all of a sudden straight up, that means that the advisors that are saying, oh, be in bonds, which high net worth individuals have more cash than they've ever had right now in regards to their portfolio, that means to me that they're out of position. And they realize they're out of position and they're having what I refer to as an oh crap moment. And that is when you see that velocity, and that's what I want to pay attention to. Do I care that I'm up here and then all I did was roll back down to here? I mean, do you want to sell that whole time? Go for it. There's no value in looking at this extreme greed, extreme level readings, or extreme fear unless you use it in context. And the two contexts that you have to use it in is you have to look at the trajectory of that move. You have to look at, okay, we have a downslope. Well, what do we have now? Well, now we have an upslope. All right, and do we have any velocity? Is there anybody that's getting us involved where we have to get in right away? Yeah, they have to get in right away. Look at this move. Look at this move from May. They're realizing that they have a problem. This would be more of a short-term or medium-term indicator, but it's something that I would definitely watch, and I'm explaining it because I don't think people should be getting hung up on how they're utilizing it. This is another one people love throwing around, this exposure index. How much exposure do these active money managers have right now? They love throwing this one around, and I get it. Let's pull this up so you can actually see what service we're using here, which is that Sediment Trader. Again, I don't make anything from it, but I just want to point out the fact of what I'm utilizing in case somebody else wants to use it. I have no interest in the company. But if you look at how this is going and you're having this reading, then what are we hearing? Oh, well, we must sell down because we're up high and this is an extreme reading. Is it an extreme reading? Because it looks to me like from 2020 to 2022 until it turned that it was pretty much always up here. And then you were here from 16 to 18. You could stay up here for 2 years. Am I supposed to act on something? What could we use here that would let us know that there might be something to pay attention to? To me, it's the same exact thing that we just went over. I would be using trajectory and velocity. You can see here that level, and then you can just see how you exploded to the upside. You can see your level here, and then you can see how you slowly ground down, and how they didn't want to be invested until you get to the point where nobody wants to be invested anymore. And then what happens? Then you have the change in trajectory, right? And you can see that change in trajectory here. I could stay up here and they could feel this way for a period of time. Just because you get here doesn't mean that they have to reverse. You could be up here for years. When you see people talking about extreme greed, extreme fear, it's completely irrelevant. It's all relative to where you currently were before and how fast you're getting to that level. The same thing here. If I saw a big drop, like let's say from this level right here, if I saw a big drop to 60, that might have my attention versus this slow move. But if I'm up here and you have this kind of reading, and then within a month or two, I'm down here 50, 60. Well, now you have my attention. Well, that's odd. That's fast. But people would say, well, that's just going back to average. Well, if I'm at an extreme bullish situation and I'm back to average, something's changed. And that's something that we want to pay attention to. We want to look for those changes. I would suggest that you use these, and I would use them with trajectory, which way we're going, down or up, and then how fast that velocity you're getting there. A couple names I'm looking at. I really like how this Key Corp acted after earnings. Their earnings were abysmal. And you can kind of see here how you ran up even though they were abysmal. Now, on Friday you sold down. That's not overly surprising. If we just overlay volume by price, you're going to see real clear where all your minutia is, where you're going to get tied up. You're going to get tied up in here. And once you get through that, you're going to push. But you have to get through this. Now, how are you going to get through this? Well, it's going to take some time. And the time that I think it's going to take, quite frankly, is going to be predicated upon what's going on in the market. If you have a weak S&P, even though financials might outperform, you're still going to have an issue. I would be looking for key levels where I'd be getting involved. One of the areas that I'm looking at is just right at the very top of this, and you're almost there. You might want to use this 9 as an area as well. I do find using a 12, a 22, and a 55 very helpful. And I do think we could come back down here. And I don't think that's the end of the move. I just think that you're going to very quietly pull back and then move higher. These are not high beta names. But go and take a look at these regionals as we were talking about earlier, and go look at who's buying into these regionals. And you're seeing a couple names that make sense. This FITB, you went up on really bad earnings. You have interest. Your moving averages are starting to spread. I'm not below the 12. I have not closed below the 12 in over a month. And all we're doing is seeing these push higher. You're going to have to get used to volatility and understanding that we're just not going to simply go up as we did before. You're seeing this in Goldman. We saw this in the trading room and couldn't really get it. I couldn't, frankly, get over it. Let's clean all this off for a minute. Just the sheer buying that I saw. I mean, it was just astounding to see that kind of move in Goldman. And it just shows you how out of pocket everybody is. And I put a little anchored VWAP from there, and you can see how that acted. Now, even here, this looks like it's a break. It's not a break, meaning it's not a break in the day. You just had that much buying that came in that day. If you want to take a look at where that anchored VWAP was from here, I mean, that's not a coincidence. Now, you have the end of the day, and the end of the day is the end of the day, especially when you have trillions of dollars in options expiring. But if you look at this, you're hanging in there on these names. Let's put this back in so people can see it all. And let's flip back to this. It doesn't mean that you have to get in right away, but it does mean that I would start looking at some of these financial names that have not rallied, that are setting up, that are lifting. If you go take a look at this on the Qs, I'll get to the Qs in a moment. Let me do it this way. I just want to point this out. Give a DTL here, downward trend line. And to me, I think you're going to flip. And we went over this in a previous video, but this DTL right here on Tesla, some are going to make it, some are not. Tesla got completely matumboed there, and you should be able to see this very, very clearly, how you're just not unable to break this level. And if you're unable to break that, it's not rocket science. You're just not going to go higher, and you can see it right there. So I would pay attention to this kind of stuff when you see these names get to that DTL. And what I was going to refer to here real quickly, I don't want to go off on too many tangents, is you want to see what does break their DTL. In other words, this had one. People, they don't work. Okay. When you see something like this, it's a pattern. People trade patterns. I'm a pattern trader. There's a reason that this pattern exists. If we see something like this, I want to pay attention to it. I want to know when I'm breaking that level right there, because what that lets me do is that lets me know that I might have demand, because you had supply this entire time. I mean, from that break, you had supply. It's not that hard to see that you had constant selling. Now what do you have? You don't have that. So let's get back. When we see names like Goldman setting up like this, you want to pay attention, or at least I want to pay attention, because I have these points of interest right here that we can all see. And what's great about them is it's going to tell you very quickly if we have an issue here or not. Now, on top of all that, you have volume right here that is well above average and well above anything we've had since April. I want to pay attention to this. This is something that I would pay attention to. I don't think I could be any clearer or say it over and over again. If you take a look at Schwab, this is one we played with in the room, and we did okay. We didn't do great. My goal was to try to get up and in before earnings, as I just don't play earnings. I just not the way that I trade. But if we just come straight across here, drop our level, right, you can see your control bar right here, and you can see very clearly on that control bar that you're just unable to, I'll get used to this drawing tool, that you're unable to make that that rise, but you have to give it time. You can see the break right here and how you finally are over after that week. And this area has been an area of contention for some time. So it's definitely something that we're going to want to watch, make sure we stay above. But breaking below that tells you everything you need to know. If you're a long-term trader and you're trying to stay in this, you just don't want to break that level. Your volume's picking up a little bit. It's kind of hard to see there. We'll blow that up now. But you can see your volume's picking up on the weekly basis. Got that 50. I use a 50 here. And I think that it's worth doing on a longer term to have a longer term moving average there, because it really shows you some of the anomalies. I like these names, and I think those three names are names that financials that I'm looking at. I'm sure there's others, and you can comment below on which other names in financial that you're looking at. But I do think that those financial names are worth paying attention to. Some of the other names we should probably cover. Let's talk about what's going on here. With Apple, I've got huge volume, and then I'm sitting up here, and I had someone talking to me and saying, is this a gravestone doji? And I mean, not to be technical, no, but you're darn close to one. It's not what you want to see at the top of a chart. We all know that wicks are price rejection, and you have nothing but price rejection up there. Now, does that mean that we're going to put the high in? I have no idea, and nobody does. What I would worry about if I was long here and we had a trade but we're no longer in it, this particular level, I would worry very carefully that we don't break that lower low. Because if you break that lower low, well, then you have this 45-degree angle, and that could mark the top of it. And if that marks that top, well, then that's a long way down. And I don't know where we end on that, but that's not something that I'd want to play with. And you have a history of this bar marking tops, and we should probably just go through that, whether those tops are short-term or long-term, but you should be able to see this here and how that kind of very similar bar marked the top on Apple. That's not what I want to see at all. It should not make you feel warm and fuzzy if you own that name. And you can just see this pattern in a couple different spots. And it's a different format of that pattern right there, but it's still there nonetheless. And you're going to see that gravestone, wherever you see them, you usually have some weakness to follow. Doesn't mean you're going to have, ultimate weakness, but you want to pay attention to that and say, okay, is this something that when it happens, how do I respond to it? This is obviously a little different, this doji here that marked that top. But you look at these little buttons, and when you see them, you'd have to pay attention to that. That have to be something that you would look at and go, well, we've been here before, and when we get this is an issue. Here you have a doji, and then the doji makes a decision. You try, it fails, it is what it is. But when you have something that glaring, you want to pay attention to it. I certainly do. Now, if we look at Meta on a weekly, this doesn't get more obvious. We had a really nice trade in this, and we no longer have a position in it, but if you take a look, you got right at the top of that control bar, and then what happened? You just stopped. Do you need to be buying Meta in here? I can get into these on the daily chart too and look at them. But some of these weekly moves, I mean, this is just glaring stuff. You had this huge run up, you got to the control bar, and now you stopped. I see a lot of people saying, well, Threads dropped off and no one's on Threads. It's only doing 50% of what it once did. I have no idea. I have no idea how that plays out. I have my belief on it. I think Elon has some real problems with Twitter, quite frankly. But we'll see how it plays out. I would just watch those levels. It's something that I think is worth bringing to your attention. You just stop dead here. And I call these control bars. You can call them whatever you want. But this bar has been in control of this entire chart. That's why I call them control bars. When you find control bars or control patterns, to me, it helps you identify how you should be viewing the world. You never were able to get above this since 22, and you still can't get above it. So this bar and whoever is doing this is in control. You can see down here how you got a completely different pattern off that volume. And what did that do? That gave you a new control bar. And then you got this control bar, which clearly got you above everything here. And then you just lifted from there. And then what'd you get? Another control bar. These are ways to determine how your chart's going. And I always use them to determine and tell me who's in control. It's very clear to me who's in control here now until I get through that. And I like Meta. I like it as a trade, but not right now. Now, if you drill this into a daily and you zoom in where I'm at and looking at these, just to forget this, I can do a whole video on them. But our level here, this was your first level. Now, are you going to hold that low and test it? I'm not sure. And I would be suggesting to everybody that you do a couple things on all your charts, especially tech. And it's interesting because I put a video together this weekend, or this past week rather, where I talked about that we were due. And we've been talking about it for 2 weeks. And you never know when it's going to happen. But I put a video out and everybody was upset about the title and the pullback that I was suggesting was coming. There might be something to that, which is kind of funny. Can we use ourselves to create some kind of oscillator or indicator that we might be near some kind of high for traders? We probably could. But you see that 22. When was the last time I closed under the 22? Here. What got us through? Earnings. Well, I don't have earnings till here. When are earnings? At 26. Okay, so they're going to do it again? Are they going to pull the flim flam again and then rip? Maybe. Maybe that's what's going to happen on Wednesday. Remember, 40% of all S&P stocks come out with earnings this week coming up. And on top of that suck salad, we get a Fed. So we have a lot coming out. But the purpose of me going through this, purpose of me showing you this is, do you really want to be buying this here going into earnings? And then I've got my RSI rolling and breaking that 70. That's not something that, makes me want to jump into the name. You start looking at Microsoft. Well, what happened when we got to the 22? Okay, well, again, that doesn't mean that I need to get in or out of that stock. What I would do is see, are we going to hold that 22, build, and then come off of it? If the answer is yes, then I have an interest in that. If the answer is no, then I don't have an interest in it, so I want to watch. And I want to go through a bunch of these big dogs. Now, Netflix to me is in a whole heap of trouble. When people finally went through this report and took a look at it, and that's why you had this day where you couldn't get above the 12. It became very clear that they spent $1.5 billion to get the amount of subscribers that they got. And when people started drilling into that, they became concerned. And that's where we saw the issues. That's why you saw the follow through the next day, and why you might see even more of a follow through. Currently I'm short this, and I have puts in it. I'm doing quite well with it. The purpose of me doing that and why I did it was not just technically when we broke here, but fundamentally understanding the story. I would strongly suggest that you start putting as much time into understanding fundamentals as you do technicals. People want to look at these lines and just say, oh, it's simple. Look at this. We've done this. When you understand the story, you will understand why people are getting out of trades. Okay. And that's a really important distinction. And I should probably go through this. One of the things that people didn't understand is when this APLS broke, they don't have a drug. They don't have a product. If you don't understand this story and what happened here, you don't understand why it dropped 30 points from here. What did you have to do this day? What was the move? Well, if you understood the story, the move was to short the stock and you never had to cover, or buy puts and you never had to cover. And you had quite a good week just doing that. But you have to understand the story, or you have to at least understand the basis of the story. You should be able to understand what is going to move these stocks within 30 seconds if it happens. And for me, looking at that, it makes a lot of sense. And I'll show you an example with AMC here. But if you look at this and you look at what's happening here, how could you be excited about getting involved in that? And this should remind everybody of something like this, where you start looking at AMD. Now, AMD cracked here, and since then, we haven't gone near it for anything more than a trade. Then you watch what we refer to as those control bars that we talked about. And let's look at it this way, it'll be cleaner. We talked about these control bars. Well, there's the top of that control bar. And you can see very clear here as I talk about this pattern all the time. You kind of have these devil horns right here. I always view this as kind of the face. Again, someone in the comments said I need therapy if that's what I see, or more than therapy, and I agree with you. But you can see it in here. To me, I can see it anyway. Just think about it from that perspective, or call it a space invader. I don't really care what you call the darn thing. But if you look at it, you try to break. What's this? Your control bar. Okay, then what happens here? You fill here. All right, now we gap fill. All right. Tries to rally back to the bottom of the space invader, or the devil horns pattern, whatever makes you happy. And then you rally to it, pull back, try to get through again, can't, and then pull back. All right, now you know what's going on there. AMD did not have good earnings here. Right, let's be real clear about that. This was not a rosy picture AMD did. Okay, they pulled out the Flex Pro and said AI a million times, and we have an AI deal too, and Nvidia ripped, and that's why we went up 50%. This caught that frenzy. Right? Let's not think that it's something that AMD did. It's not. Matter of fact, she was very calm, I should say, about the future is the best way to say it. And Taiwan Semi showing us that, and we'll get into that. We went over it this week, but we should probably talk about that a little bit. You can see this, and you can see what's happening here. So then we take this and we overlay our moving averages. See how all this connects? And we know what happened here, and we know it wasn't great. We know what just ASML did in Taiwan Semi. We'll probably cover that. We'll cover it. And I'm looking here. I'm currently short this. Now, I don't know if it's going to work or not, but I'm below that 55. That's an issue. I have a doji just sitting there. Look at this on a weekly. Now, off that weekly, what we're going to do is just put this back as a weekly. I'm going to clean all this off. So start. What do I have? I have a bear flag. No matter how you want to look at that, I have a bear flag. And now with this bear flag, I look at my low and I look at where I close on the weekly, and that's where I'm closing. Now, if I start to break this level and start breaking these wicks, and I'm already getting there, and I'll show you why I think we're getting there. I use these bars, and I only care about the bodies when I look at bearish engulfings or bullish engulfings. And the probability of the bullish engulfing or bearish engulfing is just a little bit greater than 50%. So it does give you an edge, but it doesn't give you as big of an edge as people think it does. But what does give me a bigger edge are failed patterns. In here, I have this failed pattern. I have a bullish engulfing because this bar was red, the next bar was green. I'm just using the bodies, that's all I use. Even if you use the wicks, it's there on both of them. So if you look at that body encompassed right here, this one's encompassing that. I have a failed bullish engulfing followed by a bearish engulfing. That is not something that would make me think that we're going higher. I don't know that we're going to just fall out of bed. You had some kind of bid out there on Friday for sure, but I think that might be tied to the indexes more than anything else. If you look at this on an hourly chart, the patterns get even more obvious as to where we broke, how we were unable to rally. And you can see here, all we did was really work off the oversold and try to rally. And now we're starting to already roll again. Now we have to see what happens on Monday because again, we had trillions of dollars of options expire. But I think that's worth noting. Now, American Express did not do us any favors. I currently have a short position in this. And Amex just didn't do us any favors. They increased their loan loss. Everyone said, well, it was a great quarter. It's not a great quarter if you're increasing your loan loss provisions and your Amex. And the reason for that is Amex has higher end clientele versus Capital One. Well, if they are concerned about the high end client, that might be an issue. That could mean that there is something with the consumer that we need to watch. And you can see very clearly here, you had the breakdown. You were never really able to rally, and then you kind of fell apart here towards the end of the day. But we'll see how that plays out. But you did close below that level, and I think that this is pertinent. And it doesn't mean that everything is going to fall out of bed, but it does mean that we want to watch these very carefully. This was something that we have a trade in, we did exceptionally well with. You're not breaking down on everything. Okay, some of these names that were beaten down are going to become leaders. There's a reason why somebody gave these guys billions of dollars to go out and generate loans with. They have their stuff figured out. Now, whether or not you hold UPST into this level or not, that remains to be seen. We just don't have an answer to that yet. I don't have an answer to that yet. So that's something that I want to watch. If I look at this on a weekly and I drill into this, I like everything that I'm saying about this chart. It doesn't mean it's going to go straight up. You could come back down and pull. But I think these kinds of names you want to watch because there's a story there. It reminds me a lot of when we're looking at Rivian. There's a story here. This is the weekly on Rivian. You can kind of see how you're forming that flag right here after the delivery news. And I don't really think that Elon has a good story here for the Cybertruck. I really don't. The idea when he came out and said, oh, one of these trucks is going to be worth $15,000. Okay, well, we've been hearing that about a car for about a decade now. Still don't have it. The idea that there's going to be a competing real competition here, I just don't see it yet. I don't like what happened on Friday. And that is a concern of mine with this particular name. We have a position in it, we're up in it. I actually added to it, and people want to say, talk about your losses when you have losses. I had a loss on a day trade here where it just did not do what it was supposed to do. And it was absolutely glaring. I'll just show you real quick here. You can see your bar on the gap up and it looks beautiful. You're above everything. And so I had a little 5-minute orb trade right here, boom, and then we just rejected. And so that would have been my stop on the VWAP of the day, or you could just use here when it broke, and that would have been it as well. Either way, that would have gotten you out of this trade, and it just didn't work. And rates they're not going to work. Long term, I still have a position in it, and I like it. But I am very cognizant of the fact that now I've been up here 3 times and I've rejected 3 times. And I think that if you're a trader, you need to be cognizant of that if you're trying to trade this and you have this long-legged doji here, which is in control. You should be able to see this, but I'm just going to draw these lines so you can see it. See, that's your control bar. And you would say, well, why is that the control bar? Well, you haven't come out of that, have you? You cannot close below or above that bar. That bar is in control. The battle that's been fighting here that caused this doji between buyers and sellers, that battle's been going on for 2 weeks. It's going to reach a decision. And what I don't like is when it tried to break out again, like crabs in a bucket, it pulled you down. So you want to watch this, but I do like the name longer term, and I do think that there's other names out there besides the financials that we should be looking at. Here's a really good example. SLG, this is one where they came out and they sold a portion of a building that they owned at 245 Park. These REITs, not every REIT, I want to be real clear about this. If we see a problem, which we saw in the commercial real estate business, we saw this whole issue with commercial real estate. No one's going to go to the office anymore. We're all going to work at home and we're all going to have robots. Right? If you think about it and you say, okay, well, no one's going to go to the office anymore. So these buildings are worthless. Well, they're not worthless. And what SLG did was sickly brilliant. They sold a portion of their building. They didn't sell the whole building because they frankly did not want to sell the building. But they sold a portion of a building, 245 Park, for $2 billion. And their book value is $77. What they did was they marked their book. They went out there and got an actual mark and said, because it's not like you're selling a home where you can just go to the average price of a home. I mean, what's the average price of something selling on the 200 block of Park Avenue in New York? Once a decade, something might be for sale there. What this is telling you is, hey, our bookmarks, where we're telling you book value is probably pretty close. And that was the day that you saw these kinds of moves. Now, you had earnings come out and they were awful. And of course they're awful because why? People aren't going to the office. What are they going to have to do? They're going to refinance at lower rates. They're going to have to as rates drop, they're going to have to refinance, but no one's going to refinance at the same LTV. They're going to want more protection. What's that mean? Well, it's going to eat into profitability. I got it. I understand all that. But that doesn't take a company with a book value of $77 and make it worth $30 if they're still paying their dividend, if they're still operating. Because someone could legitimately come here, buy the entire company, split the company up, and make a very nice profit. You need to pay attention to when these things are trading at huge discounts to book value and try to understand why. Sometimes there's a reason, like VNO is one that people are playing and love. Now, the reason I'm staying away from VNO is because they stopped their projects in New York and they suspended their dividend. There's way more upside here. But when you suspend your dividend, the chances of you putting that dividend on back at any time, you're pretty far out. SLG didn't do that. SLG's been paying the dividend. They mark their books. To me, when I look at this, and I think we're up about 10 or 15% in this, three or $4. What I like about it is I could mark this down, and I could say that this is worth 20% less on book value. Right? I could say that commercial real estate in New York City is going to come and drop 20% more. Which would be worse than the great financial crisis. It would be like almost a depression. That puts me at roughly $66. Okay, so then I take from my 20% correction to book value and the worst commercial market that we've ever had. And then I assign 10% off of that. I still have a double. When you start to think like this, and this is what I was saying earlier, you have to start looking at fundamental analysis. Fundamental analysis does not tell you when, it tells you what. Another example of this is when we did this with Toll Brothers. We bought Toll in the 40s. We got out way too early, and I don't mind getting out early, just go find another idea. There's plenty of them. Just think in terms of abundance, not scarcity. Anyway, you see how you acted here? Nobody wanted to own it trading under book value. It's another one. Nobody wanted to own it trading under book value. We did exceptionally well with this. No one's even talking about it. Just kept grinding over and over and over again. Fundamental analysis. When you start understanding the stories, you can do better. Spot. Nobody understood this when they came out with earnings here. And now they're raising prices and people are talking about buying it. We got in 30 points ago. Why? Because we understood the story. I understood the technicals, which tell me when, but they don't tell me what. That's where the fundamental part of it is. I would start trying to learn fundamentals. That's my little speech on that. But it would play into names even like AMC, and let's clean all this off. You're going to say, well, how does the fundamentals play into AMC? Well, not just understanding the fundamentals of this company, but understanding why companies like this move. This had a court date that came out the other day, and we all saw it on Friday, or maybe you did not. But it's had a court date that came out the other day, and where they were trying to get the APE shares to convert into AMC shares, and essentially the judge denied it. And this is why it went up. Well, why would it do that? Well, you have 140 million shares that are short this name. And what they were doing is they were shorting AMC, and this comes into understanding fundamentals of market structure. They were shorting AMC, and they were going long APE. And they were saying, well, they're going to be worth the same amount of money because I'm going to be able to take my APE shares and I'm going to be able to convert them into AMC shares. Okay, well, no, you're not, according to the judge. And it's going to be dilutive, and I think they're going to have a real issue with this. I would expect them to file at the appeal and try to do it again. But you have 140 million shares short. Where do you think this is going? The rate of borrow, and again, this comes into fundamental analysis, but of market structure. The rate of borrow is 900%. Who in their mind is staying short this at a 900% borrow rate? It's absolutely insane, and 22% of the float is short. Why would you stay short this? Understanding that would let you believe that this has massive potential. I took a long position in this on Friday. Not huge, small, but I have one. It's worth disclosing. I look at this and go, understanding that kind of market structure will let you know that this has that kind of potential. Now, do I think that people want to get caught again in this name and get squeezed? And I'm not suggesting that you're going to 50 or you're going to explode to the upside here. What I'm simply saying is, if you think that you can't see some kind of spike as everybody panics to cover their short, I would argue that you have a greater chance of that. And the reason people say, well, why would you have a greater chance of that? Well, there's more stocks to short now. Technology's coming in. We're seeing it. There's better ideas to short. Why are you shorting a $4 stock that could rip on you and that you have to pay such a high cost to borrow? It doesn't make any sense. I would watch this Monday morning. I think this has huge potential to be extremely volatile. That's it.